Hey guys, it is Julie here with TipRanks. Today we're doing something a little bit different and taking a look at stocks that analysts have been rating a sell. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Today we are shaking things up. Instead of looking at which stocks are picking up a lot of buy ratings, we're focusing on the opposite and seeing which stocks analysts are rating a sell. Now this could be for a variety of reasons that you guys are interested in this, whether you're looking to make money on short selling or put options, or simply which stocks to stay away from. So we use this TipRanks Stock Screener to find these stocks coming in with sell ratings. Found on the TipRanks website under Research Tools, we headed to the Stock Screener, and I didn't put in many filters besides looking for a moderate or strong sell consensus and trading on the major exchanges. And from there, I found 4 fairly well-known names that have not been getting the love from Wall Street analysts lately. So we're going to take a look at their stocks and what has analysts fearing so bearish. Don't forget, if you want to receive unique insights every single week right to your mailbox, to head over to the TipRanks newsletter center as well, where you'll find both the Smart Investor and Dividend Investor newsletter. There'll be links in the description down below. Now, let's get right into these sell-rated stocks. First up on our list is probably not a big surprise, as they were part of the whole meme stock, Reddit stock craze, which Wall Street was obviously not a huge fan of. We're kicking things off with AMC Entertainment. Their stock trades under the ticker AMC, currently priced at $3.69. That is a far cry from their 2020 craze, where they were above $60 per share at some point, and of course the stock has been falling since. Now if we look year to date, they are down 10%, but more notably this past week, they dropped off massively and are currently down 26% in the last 5 days. That big drop off had to do with their corresponding APE units. Following a recent ruling, the company announced a 10-for-1 reverse stock split and plans to convert their APE units into Class A common stock. AMC's APE units reacted conversely to the news, jumping up over 21% earlier this week. Along with the reverse stock split and stock conversion scheduled for August 25th, AMC also plans to issue new shares to raise capital. And while this whole ordeal will allow them to raise a lot of new money, it also risks dilution to the AMC shares. One analyst from B. Riley with a rating on the AMC stock says that their firm estimates the APE to AMC conversion could open the door for them to raise as much as $16 billion in incremental equity. And with the current projection that AMC is unlikely to move into positive free cash flow territory until 2025, the company needed access to additional liquidity to avoid a situation where shareholders were been left with nothing. The AMC stock currently has 5 analyst ratings and comes in as a moderate sell. And analysts' average price target of $2.16 would mean a downside of 41% from current prices. The most recent sell rating came in just today from a 5-star analyst at Roth MKM. He gives a price target of 50 cents, which would be a downside of 86%. We do have one hold rating from B. Riley that did have an upside of 22%. Our second sell-rated stock is another company that really busted out of the gates during the pandemic, but has now fallen since. That is Beyond Meat. Their stock trades under the ticker BYND and is currently priced just above $12 per share. Now, if we look back, they IPO'd back in 2019 and absolutely soared following that, including some big peaks during the 2020 crazes there, but have fallen considerably since. The stock is down 27% in the last 6 months and has taken some big drop-offs this past week. Beyond Meat was massively popular when they first came on the scene and were a dominant name in the plant-based industry. But then a recession came and consumers were eating out less and also looking to save costs on their own groceries, and now Beyond Meat has ran into revenue troubles. Looking back at the company's earnings, they did have a couple positive earnings per share right at the start back in 2019, but then have been dropping further and further into the negative since. And in recent quarters, they have come out a bit better than analysts' expectations on earnings per share, with the most recent on August 7th beating by just 1 cent. But if we take a closer look at the revenues, they came in at $102.1 million, and that was a decrease of over 30% year over year. And on top of that big year-over-year decline in revenue, the company also lowered their future outlook for net revenues for the year as well. They noted ongoing category headwinds compressed their net revenues, which in turn impacted product sales mix and gross margin, and this did overshadow their significant strides in operational efficiency. They said that while they are reducing their full year 2023 net revenue outlook, they nevertheless expect a modest return to year-over-year top-line growth in the third and fourth quarters of the year. But Wall Street analysts remain unconvinced. In the weeks following their earnings report, we've had all holds and sells. JP Morgan analyst Ken Goldman said that the company delivered another disappointing earnings release and that we don't have visibility at this time into when the trend bottoms. And a Bank of America analyst said that their cash flow remains elusive. With 7 current analyst ratings, the stock does come in as a moderate sell. And with an average price target of $8.25, analysts forecast a downside of over 33.5%. Down below, we can see all of the ratings coming in within the last 9 days. We do have our one hold rating with a slight upside of 5.5%, many others ranging from 51 to 63% downside. Third on our list today, we're taking a look at luxury retailer Nordstrom. Their stock trades under the ticker JWN, currently priced just above $19 per share. Now, these guys have had some more ups and downs here rather than just downs. Over the past year, they are down 24%, but year to date up 25%, 9% in the last 6 months, up 35% in the last 3 months, and down 9% this week. So quite the roller coaster for Nordstrom. Recently, Nordstrom has been dealing with an overall weak retail environment as inflation has waged on and a decline in mall traffic. They've also been working to try and modernize their business to more of an e-commerce platform. In their fourth quarter earnings report back in March, the company did announce their decision to wind down their operations on the Canadian side, saying it will enable them to simplify their operations and further increase their focus on long-term profitable growth in the U.S. And following that announcement, you can see plenty of other announcements coming out about new locations being opened up in America. In their most recent report at the end of May, the company did come out with a surprise earnings beat. While revenue did slightly miss by $50 million, their earnings per share of 7 cents was well ahead of the anticipated loss per share of 10 cents. But they did see their net sales decrease 11% year over year. Their next earnings report is coming up soon on August 24th. Analysts are anticipating a pretty big increase to earnings per share, projecting it at 45 cents. The Nordstrom stock is currently rated a moderate sell with 7 holds and 5 sells, so we're leaning a bit more towards the holds on this one. The average price target of over $17 would be a downside of 10%. We do have some recent ratings in the last couple of weeks, but many of these price targets are from a few months ago, and we'll see them be reiterated following the report next week. The most recent rating did come in a hold with an upside of 18, and one before that a sell with a downside of 17%. And our fourth stock to be picking up sell ratings is Upstart. Their stock trades under the ticker UPST, currently priced at $33 per share. Now, this is another one that really busted in onto the scene back in 2020, seeing massive growth, hitting highs of $367 per share before taking a massive cool off here. But if we zoom into the past year, they've been on the run here lately since May, but now in August have been falling off once again. The Upstart stock started falling on August 8th following their earnings report, where they did come out with an earnings beat. For their Q2, they reported earnings per share of 6 cents, which was well ahead of the anticipated loss per share of 7 cents. However, if we look over at the revenue, it came in at $136 million, and that was a decrease of 40% year over year. And the company also issued guidance that was below expectations. On their earnings call, management did note that growth in the short term was likely to be constrained by banks being cautious about lending and therefore funding its loans. And we have a ton of analyst ratings coming in following this earnings report. One analyst with a sell rating did actually increase their price target. They noted that the Q2 results were okay across the board, saying that the firm remains cautious on the shares despite incrementally more positive results. One analyst from Citi Research noted that he was concerned about Upstart's reliance on repeat borrowers and their continued funding challenges. To that end, they remained bearish on the stock near term, believing that higher interest rates, cumulative inflation, and the gradual return of student loan payments, it could get worse from here. Of course, it's always important to look at the other side as well, as there are some who do believe in the stock. One analyst from BTIG is feeling optimistic on the Upstart stock, saying that while the name will likely trade down given lofty investor expectations, we remain more bullish than the street. We continue to see strong adoption among bank credit union partners, improving loan performance, and expect cash flows relative to targeted levels. The Upstart stock does have 14 current analyst ratings, coming in with a mix all across the board. Overall, they do get a moderate sell rating based on 1 buy, 6 holds, and 7 sells. The average price target of nearly $29 would be a downside of over 13%, and we see all of those recent ratings pouring in this past week here. Of course, our optimistic BTIG gives the stock an upside of over 92%. While we do have some holds floating in the middle, our high-end downside comes from Wedbush with a 70% downside. So there we have 4 companies that are not getting the love from Wall Street lately. Let me know your thoughts on these companies in the comments down below. Do you agree with these analyst sell ratings or not? I always appreciate hearing from you guys. Keep in mind these videos are never a suggestion to buy or sell any specific stock, just keeping you up to date with what those Wall Street analysts are looking at. So please make sure you're always doing your own research and due diligence. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.